At some point, investing stopped being boring, and that should have terrified everyone, because boring was the entire point. For decades, investing meant slowly owning pieces of real businesses, factories, railroads, banks, companies that made actual money selling actual things to actual humans. Then, somewhere along the way, Wall Street looked at Vegas, looked at social media, looked at smartphone addiction, and said, why are we making people wait for dopamine? Now your brokerage app vibrates like a slot machine. Sports betting apps live next to retirement accounts. Crypto charts move faster than human emotion can process. Teenagers trade options contracts in between DoorDash orders. And everyone calls this financial literacy. Here's the thing. People think they're investing. They're not. They're gambling with prettier apps. Robinhood basically turned the stock market into DraftKings with candlestick charts. And it gets worse, because modern finance figured out something terrifying. Human beings don't actually want wealth. They want stimulation. That's the real product now. Not ownership, not dividends, not long-term returns, attention, volatility, the feeling that your life could change by Friday. And once you notice it, you can't unsee it. Because suddenly, everything starts looking like the same machine. Crypto, meme stocks, sports betting, prediction markets, zero DTE options, NFTs, parlays, leveraged ETFs, different wrappers, same dopamine factory. This isn't normal. Investing used to feel like watching paint dry. That was considered good. You bought shares in boring companies. You reinvested dividends. You waited 30 years. Then, hopefully you retired without eating cat food. That was the game. Warren Buffett became famous precisely because he was boring. The man basically built a $1 trillion empire by acting like human oatmeal. Meanwhile, today, people won't hold an asset longer than they hold leftovers. The average holding period for stocks in the 1960s was around 8 years. Now, sometimes it's less than 6 months. For options traders, it's days, sometimes hours, sometimes 14 minutes and a panic attack. Which brings us to meme stocks, GameStop, AMC, Bed Bath & Beyond. Companies priced like gravity doesn't apply. Entire communities formed around losing money together with the emotional intensity of a medieval cult. And look, some people did make fortunes. That's what makes the casino work. Vegas doesn't need everyone to win. It just needs enough winners to create legends. Because legends create addicts. Nobody posts, just made a responsible 7% annualized return through diversified index exposure. No, people post screenshots of turning $4,000 into $400,000 using options contracts held together by caffeine and divorce energy. And social media amplified everything. TikTok finance, YouTube traders, Discord pump groups, Twitter stock profits with anime profile pictures explaining macroeconomics from their kitchen. Everyone became a financial expert during the biggest liquidity flood in modern history, because everyone's a genius in a bull market. Let that sink in. Between 2020 and 2021, retail trading exploded. Robinhood added millions of users. Options trading volume hit record highs. In the US, daily options contracts started outnumbering actual stock trades, and not boring options either. The fastest growing category became zero DTE options, 0 days to expiration, which is basically financial cocaine. You're no longer investing in companies. You're betting on whether Jerome Powell breathes too aggressively during a press conference. Meanwhile, sports betting went nuclear. After the Supreme Court legalized sports gambling expansion in 2018, the industry exploded across America. Billions poured in. Apps made gambling frictionless. You no longer drive to Vegas wearing a Hawaiian shirt and bad decisions. Now you lose rent money silently in bed at 1:13 a.m. while eating cereal. Progress. And the craziest part? The apps all started looking identical. Trading apps copied casinos. Casinos copied video games. Video games copied social media. Social media copied neuroscience labs, bright colors, confetti animations, push notifications, near-miss psychology, a feedback loop that's beautiful right up until it isn't. Because the system learned something very important. Volatility keeps humans engaged. Stable wealth creation is emotionally boring. Nobody refreshes their portfolio 19 times a day because their index fund gained 0.04%. But tell someone a meme coin could 40 times by Tuesday, now the monkey brain activates. This is where smartphones changed everything. Before smartphones, gambling required effort. You had to physically go somewhere. Now the casino lives in your pocket. And unlike old casinos, this one knows your behavior better than you do. It knows when you're emotional, when you're bored, when markets open, when your team loses, when you're lonely, when you're scrolling at 2 a.m. wondering if buying dog-themed internet tokens counts as financial planning. And algorithms learned that outrage and greed outperform patience every single time. Patient investors don't create engagement. Chaotic gamblers do. That's why financial content slowly mutated into entertainment. Nobody wants how compound interest slowly builds wealth over decades. They want, this 18-year-old turned $300 into a Lamborghini using leverage and sleep deprivation. Modern investing became content. Content became speculation. Speculation became identity. And that's the uncomfortable truth. People don't just want money anymore. They want a story. They want escape velocity. They want to believe they're one trade away from freedom, which is why markets now reward attention more than fundamentals. A boring, profitable company might barely move. Meanwhile, a bankrupt company with a viral hashtag suddenly levitates like economics was replaced by astrology. We created a market where narrative often matters more than cash flow, where attention itself became an asset class. Prediction markets bet on elections. Fans gamble on sports statistics. Crypto traders gamble on memes. Retail traders gamble on earnings volatility. At some point, the entire economy became one giant prediction engine. Everything is a bet now. Housing, stocks, sports, politics, crypto, even social status. People are pre-ordering hope, and hope sells extremely well, especially during economic uncertainty, especially when wages feel stagnant, housing feels impossible, and the traditional path to wealth feels slower than airport Wi-Fi. Because if normal life feels financially hopeless, speculation starts feeling rational. That's the dark part nobody talks about. Gambling behavior spreads socially. If your friend makes 6 figures on crypto, your brain doesn't process risk. It processes regret. You start feeling stupid for being careful. Suddenly, patience feels irresponsible, and boring investing becomes emotionally impossible because your timeline has been poisoned by viral success stories. This is why bubbles always feel intelligent while they're happening. There's always a narrative. The internet changed everything. AI changes everything. Crypto changes everything. Sports betting is skill-based. This time is different. Every era invents new language to describe old human behavior. Greed, wearing modern clothing. And look, some of these technologies are real. That's what makes it complicated. The internet was real. AI is real. Crypto has real applications. But bubbles don't require fake technology. They require real excitement mixed with unrealistic expectations. That's the formula. And modern platforms perfected it. Now millions of people wake up every morning inside a digital casino disguised as empowerment. A casino where the house doesn't always care whether you win or lose, as long as you keep playing. So, I want to know, do you think modern investing is still investing? Or are we all just sitting inside the world's largest casino, pretending it's financial education?